Saturday, September 10th, 2016. Monaco 64 here, home of alternative economics and contrarian views. I like to cover the markets this morning. It's Saturday, of course. Yesterday was a very interesting day. I made a video early yesterday before the US markets opened officially, in the afternoon here in London. I made the video in the morning, US time, and at the time the markets were still fairly calm, and I asked the question whether the bond bubble had popped, because interest rates seem to be rising since July. And I have to say, what happened yesterday was very interesting and kind of shocked me. But first of all, just talk about what happened during the week. So the Dow for the week dropped 2.19%. We closed September 2nd at 18,491, and yesterday we closed at 18,085. Yesterday on its own, the Dow was down 2.13%, or 394 points. So it's a huge move, as you can see in this chart. And we've broken back below the May 2015 highs, which was around 18,360. So quite significant move. Later on yesterday, after the US markets closed at 4 p.m. New York time, the futures on the Dow kept trading, and it was actually down 60 points before it closed. Another 60 points, to the 394, which is interesting. S&P closed down on the week 2.4%. We'd closed the previous week at 2179.98, and yesterday it closed at 2127.81. For the day, though, the S&P closed down 2.45% at 20. So pretty bad day for the S&P as well. As you can see, the chart looks similar to the Dow's chart, and we've also closed below the high from last, May 2015, which was around 2136. That's not a closing high. That was just like an intraday high. And so year to date, the Dow's up to 3.79% still, and the S&P is still up 4.1%. Now to gold and silver, and I've looked, for the weekly numbers. I'm looking now at the LBMA spot fix. For the gold, it's the PM fix, which happens around 10 o'clock New York time, and for silver, it's the 12 o'clock fix, which is around 7 a.m. New York. And the reason I'm doing that is because the gold futures, they close officially like 3.5 hours or 2.5 hours before the stock market. So it gets very thin. And, yesterday, though, I thought gold and silver did quite well. Gold held most of the day above 1330, which was a good support that I had. And silver was, comfortably above 19. But looking at the LBMA, for the week, we closed at 1330.85. That's gold, the PM fix. Compared to the previous Friday's PM fix, that was at 1324.70. So gold has actually done well, the physical part of the market, if you want to call it that. Silver, last week on September 2nd, the fix was $18.75, and yesterday the fix was $19.41. And just an idea, to give you an idea though, on COMEX yesterday, gold was down 0.53%. So with the Dow being down 2.13%, that's outperformance there. Silver was down 1.58% on COMEX yesterday. So silver also outperformed the stock markets. And I know the HUY and the XAU index were down quite heavily, over 5%. And I guess my view on that is that if you look at gold and silver and the mining shares, we're actually above where we were a few weeks ago. So we didn't make a bottom. While in the stock market, we're making we've just broken below all the gains we've made since July. While in silver and gold, we're higher. So I think the trends are different there. I guess gold and silver and the mining shares got caught a little bit in the sell-off yesterday. I'm still positive on those though. And now to the bond markets. So yesterday, the US 10-year yield on the treasuries was up 8 basis points to 167. And looking at it in terms of the range we've had in the last 52 weeks, the high is 237, so we're still comfortably below that level, but we're about 30, just over 30 basis points from the low in July, which is around 133, 134. So, and what that means is that the price of bonds have actually topped since July, even though we had a huge drop in the stock market yesterday. The fact that the 10-year yield was up yesterday, 8 basis points, which means the price was down, is quite significant, because usually, and I'm looking here, let's say back in, from December, for example, 2015 to the beginning of February this year, when the stock markets were going down, the 10-year yield actually went from above 220 to around 170. So it actually dropped because there's a so-called flight to safety. But in this case today, with the stock market, dropping almost 400 points as the Dow did, there was a spike in the Treasury yields higher, which means the price went down. It's very unusual. And the same thing goes for the 30-year yield on the long bonds. If you look at it, in December of last year, when the stock market started dropping until the beginning of February, the 10-year yield was above 3%, and then it dropped to around 2.5% when the stock market bottomed in February early this year. But yesterday, the 30-year yield moved up 9 basis points to 239. And that's what I wanted to talk about, after this summary of what we did in the markets yesterday and during the week, is that my question is now, is it the bond market bubble popping that's driving the stock market? Or was yesterday just a freak day, and we will start to, and if the stock market continues to go down, we will actually see people go back into treasuries? That's going to, only time will tell that, but from what we saw yesterday, that it's not a good sign. Markets usually, the first initial reaction in markets is usually, the reaction that should continue. Like, for example, when you have economic data in the markets come out, I remember, we always used to talk about that on the dealing desk, that the first reaction of the markets is always what will happen thereafter for the whole day. So if there's an economic number and the stock market goes up in the first minute of after the number, but then comes back down, you would still expect the market to go up on the day. That's that kind of thing. So to me, that's the most interesting thing for the about yesterday, and only time will tell. Because as you saw, in the beginning, end of last year, beginning of this year, the stock market was dumping, and actually people were buying treasuries and yields were going down because they were concerned. But now, what we're seeing, what we saw yesterday, is the stock market, not crashing, because, 2% down day, or 2.5% in the S&P is big compared to what we've seen recently. But the fact that bond yields, especially longer term bond yields like the 10-year and the 30-year, went up 8 and 9 basis points respectively, is not a good sign. So my question then, final question, is it the bond market bubble popping that's driving stock market lower now? And because you wouldn't expect to, you'd expect flight to safety, yesterday, people buying treasuries, and we didn't. So that's something for us to keep an eye on over the next few weeks, and to see if that unusual relationship continues. So if you enjoy my videos, please like, share, and subscribe them. And if you'd like to donate to my channel, you're more than welcome, and I appreciate donations. I've had quite a few donations, and I'd like to thank all the people who have donated. And the links for the donations are below in the description. I accept Bitcoin. You can pay through PayPal and Patreon. Have a good weekend, and I'll probably talk to you again before the end of the weekend. Take care. Bye.